The Strait of Hormuz is closed. Missiles landed in Bahrain, Kuwait, Qatar, and the UAE this morning. Trump has declared the ceasefire over. Explosions were reported across Bandar Abbas and Keshem Island in the last 24 hours. And gold is sitting at $4,120, doing nothing. If you've been trained to think war means gold goes up, this week is going to break that assumption, because this is not a safe haven war. This is an inflation war, and that changes everything. Let's get into the charts. Start with gold. Daily chart. Last few weeks, we were watching a bullish divergence build. That divergence is now dead. It did its job. It pushed price above 4,200, but it could not hold that level. Price rejected, rolled over, and dropped all the way down to 4,023. That's a failed breakout, and failed breakouts leave scars. But here's what's interesting. Look at the structure that's formed underneath. We now have an inverse head and shoulders. Left shoulder in early June. The head, that 4,023 low, and the right shoulder forming right now in July. The neckline of this pattern sits between 4,200 and 4,230. That is the number for this week. That's the entire trade. Break above 4,230 and hold it. The door opens toward 4,400. That's the measured target. And the descending trend line from the May highs is also coming down into that same area, which makes it a confluence zone. But, and I want to be honest with you here, I doubt it happens this week. Price has already failed at 4,200 once. Buyers tried and could not close above it. Until we see a daily close above that neckline with volume behind it, this is a pattern, not a breakout. So, the base case, gold stays in a range between 4,000 and 4,200. Write these three numbers down. 4,000, that's your floor. That's where buyers keep stepping in. 4,200 to 4,230, that's your neckline. That's the decision point. 4,400, that's only in play if the neckline breaks. Below 4,000, the pattern is invalidated, and we're looking at a fresh leg lower. Now, here's the part most channels are going to get wrong this week, so stay with me. The instinct is, war in the Middle East, gold goes up. Safe haven, fear trade. But look at what's actually happened. Since this conflict started at the end of February, gold has fallen 21%. 21% during a war. Why? Follow the chain. Hormuz gets disrupted. Oil supply gets squeezed. Brent is now sitting around $76.50, up more than $4 from last week. Higher oil feeds into higher inflation. Higher inflation forces the Federal Reserve to keep rates elevated, or even hike. And gold hates high rates. Gold pays you nothing. When cash pays you 5%, holding a metal that pays 0 becomes expensive. So the war is not a tailwind for gold right now. The war is the reason gold can't rally, and the institutions have already adjusted. Citi cut their 3-month gold target from 4,300 down to 4,000, citing the likelihood of a Fed hike this year. Bank of America cut their 2026 average forecast by 14%, down to 4,360, again pointing at a more hawkish Fed. Both of them still say 5,000 is possible, but only once the tightening cycle ends, not before. That is the entire gold story in one sentence. The upside is real, but it is on the other side of the Fed, and we are not there yet. Now Bitcoin. And Bitcoin is telling a very similar story. A story of struggle. The chart is doing exactly what it did the last time we lost the 200-week moving average in a bear market. Same script, same hesitation. Let's go through the confluences we've been tracking, one by one, because this is where the detail matters. Number 1, the order block. Minted. Done. Price went in, tapped it, reacted. Number 2, the point of control. Bitcoin has recovered the POC of the range. That's a tick. Number 3, the weekly moving average. Price is above it. Another tick. Number 4, the golden pocket, around 64,400. And this is the problem. Bitcoin has not fully reclaimed it. One candle closes above the 64,000 level. The next one closes below, then above, then below. We are chopping right on top of it. Right now, we're at 63,865, sitting just underneath. 3 out of 4 confluences reclaimed. The fourth one, the most important one, undecided. Now, is this a problem? Actually, no. This is completely normal. Look at history. The last time Bitcoin interacted with the 200-week SMA, it took 9 weeks before the market decided which direction it wanted to go. 9 weeks of chop, fake-outs, and frustration. We are only 6 weeks into this interaction, so do the math. There are potentially 3 more weeks of this left, and I would not be surprised at all if Bitcoin stays trapped in this range for at least another 3 weeks before it makes its move. If the golden pocket rejects and we lose the structure below, the first stop is the demand zone between 53,381 and 55,399. That's where I'd expect the first meaningful bounce. If we reclaim 64,500 with conviction, with multiple daily closes above, not one candle, then the bearish case gets suspended and we look higher. But until then, patience. This is not a market that rewards forcing a trade. So what actually moves these charts this week? Monday, nothing. Quiet open. Use it to plan, not to trade. Tuesday is the big one, US CPI. Headline inflation is expected to come down sharply from plus 0.5% month-over-month in May to minus 0.1% in June. Core CPI is forecast at 2.9% year-over-year, 0.3% month-over-month. If CPI comes in soft, the dollar weakens, rate hike odds drop, and gold gets a shot at that neckline. If CPI comes in hot because of the oil shock, gold gets rejected again, and the 4,000 floor gets tested. That single number is the trigger for everything. Then, and this is being underestimated, Fed Chair Kevin Warsh delivers his first congressional testimony since being sworn in. This is the first time markets get to hear him under pressure, in detail, on record. And Congress is expected to press him not just on inflation, but on crypto and Bitcoin regulation as well. So Bitcoin traders, this is your volatility event. Watch it. Also on the calendar, PPI and retail sales midweek, consumer sentiment and EU CPI on Friday. And one more. July 17th is the mandatory wind-down deadline for Iranian oil sanctions. If that deadline passes with Hormuz still closed, oil gets another leg up. And you already know what oil does to the gold story. Let me close with the one thing that connects both charts. Neither gold nor Bitcoin has conviction right now. Both are ranging, both are waiting, and in both cases, the trigger is not going to come from the chart. It's going to come from the fundamentals. The technicals tell you where the levels are. The Fed tells you when they break. Gold levels, 4,000 support, 4,200 to 4,230 is the neckline, 4,400 if it breaks. Bitcoin levels, 64,500 is the golden pocket, 53 to 55,000 is the first stop below, and expect at least 3 more weeks of chop. Don't force it this week. Let CPI print. Let Warsh speak. Then trade what the market gives you. If this analysis helped you, hit subscribe. We do this every single week. Gold and Bitcoin. No hype, just levels. I'll see you in the next one.